I want you to picture a multi-million-dollar state-of-the-art sports car.
Okay, I'm picturing it.
We are talking about an absolute engineering marvel, right? Like a V12 engine capable of shattering land speed records.
Right.
So you get behind the wheel, you press the accelerator to the floor, and the car it just sputters and stalls out.
Oh, man. Let me guess, it's out of gas.
Well, no, it's because the fuel line feeding that massive engine is like the size of a plastic drinking straw.
Oh, wow.
Yeah, it simply cannot pump the gas fast enough, and the engine just starves.
That's a great visual.
And this exact scenario is playing out right now in the technology sector. But, instead of sports cars, we're talking about multi-billion-dollar artificial intelligence data centers.
Exactly.
Everyone right now is completely obsessed with the engines, the AI processors, the GPUs from companies like NVIDIA. But the massive stack of financial documents we're looking at today tells a very different story.
It really does.
The real bottleneck, and potentially the most overlooked financial opportunity of 2026, is the fuel line. It's the memory.
It's a phenomenal analogy, honestly.
Yeah.
Because it highlights a physical reality that the market is really just starting to wake up to. I mean, you cannot build a faster AI without fundamentally changing how that AI accesses its data.
Right, and to chase that opportunity, we're seeing some pretty ruthless business decisions. Think about the last time you built or upgraded a PC. You probably know the brand Crucial.
Oh, yeah. A staple for PC builders.
Beloved by gamers for, 30 years? Well, in December 2025, its parent company, Micron Technology, quietly took the Crucial brand out back and killed it.
It's completely axed out.
Totally abandoned the consumer PC memory market. Wow. To dedicate every single square inch of their factory floor to feeding those starving AI data centers.
Yep.
So we're bringing you an extensive exploration of exactly this phenomenon today. We spent the week analyzing a mountain of documents, Q1 and Q2 2026 earnings transcripts, SEC 10Q filings, analyst research from Needham and Saxo Bank.
And those highly detailed industry supply chain reports, too.
Yes, exactly. Our mission for you today is to synthesize all this dense financial and technical data to build a comprehensive report on the AI memory market, specifically looking at Micron.
Right.
We're going to break this down into 3 core pillars. We've got the investment thesis, a valuation reference, and the potential risks. Okay, let's unpack this. How did memory go from being a boring, cheap commodity to something so valuable that a massive American titan like Micron is betting its entire existence on it?
Well, if we connect this to the bigger picture, you can see how this physical bottleneck, what the industry literally called the memory wall, has triggered a structural shift.
The memory wall, I love that term.
Right. It's so descriptive. For decades, traditional memory, like DRAM, was treated essentially like lumber or steel.
Just a basic commodity.
Exactly. You
Right.
bought it when you needed it, and manufacturers constantly engaged in these brutal price wars to win contracts. Memory sat flat on a motherboard relatively far away from the processor. But as AI models grew to, trillions of parameters, the processors spent most of their time just sitting around waiting for data to travel across the motherboard.
Starving for fuel.
Right. So, to fix this, the industry invented high bandwidth memory, or HBM.
And HBM is physically very different from the standard RAM sticks we used to slot into our computers. Right?
Oh, entirely different. Instead of laying memory chips flat side by side, HBM stacks them vertically.
Like a microscopic skyscraper.
Exactly like that. And it sits right next to the processor. To connect these floors, they punch microscopic holes straight through the silicon called through-silicon vias, or TSVs, and fill them with copper.
Wow.
This allows massive amounts of data to travel vertically and directly into the GPU simultaneously. It completely shatters that memory wall.
But I imagine manufacturing a microscopic skyscraper with copper-filled elevator shafts is pretty difficult.
Incredibly difficult.
Yeah.
And incredibly expensive. Because of that, memory is no longer a cheap commodity. It's a core strategic asset.
Right.
Hyperscalers, companies like Google, Microsoft, Meta, Amazon, they know that whoever controlled the supply of HBM controls the speed of their AI development. They're placing open-ended orders.
Meaning what? Exactly.
essentially telling suppliers, we will take every single chip you can manufacture, regardless of the cost.
That is wild. And when you look at the actual dollars and cents from Micron's recent Q2 2026 earnings report, regardless of the cost, takes on a whole new meaning.
The numbers are staggering.
We're talking about numbers that legitimately disrupt historical financial modeling. Micron's revenue for the quarter hit a record $23.86 billion.
Insane.
That is nearly triple their revenue year over year, a 196% increase. But the number that truly illustrates the structural shift you mentioned is their gross margin. They hit a staggering 74.4%.
Which is almost unheard of in the traditional memory manufacturing business.
Really? What's a normal margin?
Historically, a fantastic quarter for a memory maker might see margins in the mid-40s. Hitting over 74% shows that they're commanding massive premium pricing. Their customers have zero leverage.
Because they need the fuel.
Exactly. If a hyperscaler refuses to pay Micron's premium, their multi-billion-dollar AI data center just sits completely idle.
And this brings us back to that ruthless capital allocation decision we talked about earlier. Why dedicate precious factory space to selling a standard stick of RAM to a consumer for like a 15% margin?
When you can use that same equipment to build an HBM stack for an enterprise client and get a 75% margin.
It makes complete financial sense. But I want to dig into how Micron is actually pulling this off against their rivals.
Sure.
The memory market is essentially a triopoly, right?
Yeah.
You have SK Hynix out of South Korea, who's currently the undisputed leader with a 62% market share in HBM.
Yep.
Then you have Samsung holding about 17%.
Yeah.
And then Micron sits at 21%. So they're the number 3 player globally in overall memory, but they just overtook Samsung for the number 2 spot, specifically in HBM. How did they pull that off?
They did it through pure engineering execution. Micron possesses a massive technical advantage right now with their current generation of chips, which are called HBM3E.
Okay.
According to the engineering specs in the Saxo Bank reports, Micron's HBM3E chips consume 30% less power than the equivalent chips from SK Hynix and Samsung.
Wait, I want to pause right there. When I hear 30% less power, my mind immediately goes to, saving money on a monthly electricity bill.
Sure, that's the natural assumption.
Which is great, obviously, but surely a 30% discount on the utility bill isn't enough to cause hyperscalers to completely sell out Micron's inventory for the entirety of 2026? Like, what is the underlying mechanism making this so valuable?
It matters because of hard physical limits. How they achieve it comes down to advanced packaging techniques and materials that reduce the electrical resistance within those microscopic TSV copper pillars we talked about.
Okay, so less resistance means?
Shorter, cleaner electrical paths mean less energy is lost as heat. And that heat is the crucial factor. Data centers are literally running out of electricity, and they're running out of ways to cool these massive server racks.
Oh, wow.
Yeah, in many major tech hubs, hyperscalers cannot get the local utility companies to provision any more power to their facilities. The regional power grids are just completely maxed out.
Ah, I see. So it isn't about saving money on the power you use, it's about the fact that your total power budget is capped.
Precisely. If your facility is capped at, say, 100 megawatts, power efficiency dictates the absolute physical limit of how much computing power you can fit inside the building.
Because if you go over, you blow the grid.
Right, or melt the servers.
Yeah.
So if Micron's memory uses 30% less power, that means the data center operators can install significantly more NVIDIA GPUs in the exact same footprint.
That makes so much sense. That 30% power savings translates directly into a massive increase in total computational throughput.
Exactly. That technical advantage is exactly why Micron's management confidently noted in their earnings call that their entire HBM production capacity is spoken for through the end of 2026.
Wow. So what does this all mean for the listener? We have a company with an absolutely rock-solid investment thesis. They're building the critical infrastructure to bypass the AI memory wall. Their margins are exploding to over 74%, and their factories are fully booked for the next year. Which leads us to our second pillar, a very fascinating disconnect when we look at the valuation reference. If you're looking at your portfolio right now, you might be wondering, if things are this incredibly good, why isn't the stock priced like the rest of the AI darlings?
Oh, it's the defining paradox of this entire sector right now.
Let's break down the multiples, because the gap between the fundamental business performance and the market valuation is pretty severe.
It really is.
If you look at the broader AI hardware sector in early 2026, NVIDIA is trading at a forward price-to-earnings ratio of roughly 24x. AMD is trading at around 35x forward earnings.
Right.
But Micron. Micron is trading at a forward PE ratio of roughly 11 to 12.7x. They are growing their earnings at an annualized rate of 50%, yet they're priced almost like a slow-growth legacy utility company.
What's fascinating here is how deeply investor psychology is rooted in the past.
What do you mean by that?
The market is pricing Micron based on the ghosts of historical memory cycles. For 40 years, memory was a brutal boom and bust industry.
Right, the old commodity days.
Exactly. You'd have 2 years of incredible profits because of a new PC or smartphone cycle, followed immediately by an oversupply crisis where prices crashed and companies bled billions in cash.
So investors are just waiting for the other shoe to drop.
Institutional investors have been burned by that cyclicality so many times that they look at Micron's current astronomical profits and assume the inevitable bust is just around the corner. They're treating these AI-driven profits as a temporary anomaly rather than a permanent structural baseline.
But the financial metrics buried in these analyst reports, just the market might be fundamentally mispricing that cyclical risk.
Oh, absolutely.
The Saxo Bank sources highlight Micron's PEG ratio. Now, for those who might not live in the financial weeds, the PEG ratio measures a company's price-to-earnings multiple relative to its actual earnings growth rate.
Right. It's essentially the price you're paying today for the growth of tomorrow.
Exactly. In traditional financial analysis, a PEG ratio of 1.0 means a stock is fairly valued. Anything under a 1.0 is considered undervalued. Micron's PEG ratio currently sits at an incredibly low 0.21.
Wow.
Yeah, that suggests a severe undervaluation relative to the sheer velocity of their current growth.
The market is effectively applying a massive commodity discount to Micron. It manufactures a physical component that used to be cheap, whereas it willingly gives premium software-like valuations to companies designing the logic processors.
Like NVIDIA.
Right. But the smart money, the analysts who are digging into the physical realities of these data centers, they're starting to aggressively update their models to reflect this new world.
Which brings us to the Needham report in our stack. They recently raised their price target for Micron to an eye-watering $500.
That is a massive target.
And their methodology is really interesting because they aren't just looking at earnings multiples. They base that $500 target on a 2.3x multiple of Micron's projected 2028 tangible book value.
Let's unpack tangible book value for a second, because that's crucial.
Yeah, go ahead.
When we value a software company, we're often valuing intangible things, patents, algorithms, brand recognition. But hardware companies have massive physical footprints. Tangible book value is literally the value of the hard assets.
So if Micron closed its doors tomorrow.
Right. It's the value of the land in Idaho, the concrete of the factories, the incredibly expensive ASML lithography machines imported from Europe, the raw silicon.
So Needham is basically saying, look at the sheer value of the physical empire this company is accumulating to meet this demand.
Yes. It's a valuation methodology rooted in the physical reality of what Micron is building, rather than just the fleeting sentiment of the stock market. Because those hard assets, those mega factories, take years and billions of dollars to replicate. It represents an enormous barrier to entry.
But I have to push back here. I have to play devil's advocate for the listener, which brings us to our third pillar.
The risks.
We are looking at a stock with a low PE ratio in an industry historically known for destroying shareholder value every 4 years, like clockwork.
Sure.
Is this truly the cheapest AI stock on the market? Or is this a classic value trap for tourists who just don't understand how semiconductor hardware cycles actually work?
This raises an important question, and it's exactly why we cannot just look at the upside. To determine if Micron is a value trap, we have to look past the current euphoria, flip to the risk disclosures in the SEC 10Q filings, and ask, what happens when the global supply of memory finally catches up to the demand from the AI hyperscalers?
Because right now, every memory maker on the planet is spending money like crazy to build new factories to capture those 74% margins.
They are. The most immediate threat to this investment thesis is the CapEx glut capital expenditures. Micron alone is ramping up its CapEx to over $25 billion for fiscal 2026.
$25 billion, that is massive.
It is. They're building these massive mega fabrication facilities, or mega fabs, in New York and Idaho, while aggressively expanding their existing footprints in Taiwan and Singapore. The danger in the semiconductor industry is the massive lag time. When you decide to build a new fab today, you are pouring concrete for a facility that won't produce a single microchip for 3 to 4 years.
So they're flying blind, essentially.
Sort of. The risk is that by 2027 or 2028, All of these new megafabs from Micron, Samsung, and SK Hynix finally come online and start churning out silicon at exactly the same time.
And if the AI demand softens even slightly by then.
They flood the market with memory, and those 74% margins will collapse overnight.
And building those fabs isn't happening in a vacuum either. The SEC filings highlight some massive geopolitical concentration risks that you simply don't see in software companies.
Oh, absolutely.
Currently, 60% of Micron's production output comes from Taiwan. In the current geopolitical climate, having 60% of your manufacturing base situated on an island in the Taiwan Strait exposes the company to extreme tail risks.
It's a huge vulnerability.
Right. If there's any disruption, a blockade, an embargo, or worse, Micron's ability to supply the global market evaporates instantly. And on top of that, they're already dealing with geopolitical friction.
With China, right?
Yes, China's Cyberspace Administration, the CAC, previously instituted a ban that restricts Micron from selling its products to critical infrastructure operators in mainland China and Hong Kong. So they're effectively locked out of a massive portion of the Chinese enterprise and government market.
Geopolitics is a major vulnerability, but so is the fundamental fragility of the global supply chain itself. We have a tendency to view these megafabs as autonomous, magical machines, but they rely on highly specialized human labor and incredibly delicate logistics.
Like the Samsung strike.
Exactly. Look at the labor dispute happening with Samsung in our industry reports. The National Samsung Electronics Union, the NSEU, recently voted for an 18-day strike at their Pyeongtaek plant in South Korea.
Wow.
And that single facility is responsible for a massive percentage of global DRAM and HBM production.
Which is fascinating because, ironically, a strike at a competitor like Samsung might actually help Micron in the short term, right? It chokes off the global supply, which keeps global memory prices and Micron's margins sky high.
In the absolute short term, yes, a competitor's supply disruption boosts Micron's pricing power. But strategically, it should make investors very nervous.
Because it shows how vulnerable the whole system is.
Precisely. It highlights a terrifying fragility. If a localized labor dispute at a single facility in South Korea can threaten the global supply chain for AI development, it shows how delicate this entire ecosystem really is. A single disruption in raw materials, chemical precursors, or labor can halt production globally.
And even if they navigate the geopolitics and the supply chains perfectly, there is still the risk that keeps Micron executives up at night. The sheer ferocity of the technological competition. Keeping that technical lead, that 30% power efficiency advantage we talked about, is a brutal, never-ending treadmill.
It is relentless. The industry is already transitioning toward the next generation of memory, HBM4. And the jump from HBM3 to HBM4 is a massive leap in engineering complexity. HBM4 introduces a 2048-bit interface.
Okay, here's where it gets really interesting. Let's use an analogy to picture a 2048-bit interface.
Sure.
If the data connection between the memory and the processor used to be, say, a standard 4-lane highway, moving to previous generations of HBM expanded it to a 1024-lane highway. Now, with HBM4, they're trying to build a 2048-lane superhighway, all operating in perfect synchronization at microscopic scales. The engineering required to prevent data traffic jams or electrical interference across 2048 lanes is mind-boggling.
Exactly. And this is where Samsung becomes a terrifying competitor. Samsung stumbled in the previous generation, but they are bouncing back aggressively because they possess what the industry calls a turnkey advantage.
Wait, so by turnkey, do you mean Samsung is essentially acting as a one-stop shop? Like they bake the cake and put the icing on it, whereas Micron only bakes the cake?
That is exactly it. As these 2048-lane superhighways get more complex, the memory has to be perfectly seamlessly packaged directly with the logic processors.
Right.
Samsung operates both as a world-class memory manufacturer and a world-class logic foundry. They can design, build, and package the entire stack under one single roof for an AI client.
Oh, wow.
Micron is a pure-play memory maker. They build the memory, but they have to rely on external partners like Taiwan Semiconductor, TSMC, to handle the logic integration.
Which introduces friction and potential delays.
It does. And the margin for error is essentially zero. The reports detail how Micron is currently transitioning to their new 1-gamma manufacturing node.
What does 1-gamma mean?
It refers to the microscopic scale of the transistors, using extreme ultraviolet, or EUV, lithography. We're talking about drawing circuits just a few atoms wide. If Micron missteps in the engineering, yields for this 1-gamma node.
And yields meaning the percentage of chips on a raw silicon wafer that actually work without defects. Because if your yield is low, you're basically throwing half your factory's output into the trash.
Precisely. If Micron struggles with their yields on HBM4 or 1 gamma, their costs will skyrocket, and that technical edge they currently enjoy could vanish overnight. In the semiconductor industry, you are only as good as your next fabrication process. Lose the technical lead, and you lose your pricing power to SK Hynix and Samsung.
So bringing this all together, we've built a complete, comprehensive report from a mountain of financial intelligence. You now have the three pillars. First, the rock-solid investment thesis. AI processors have hit the memory wall, and memory has structurally shifted from a cheap commodity to a high-margin strategic necessity.
Driving those record triple-digit revenue numbers.
Exactly. Second, you have a clear valuation reference. While the stock has soared, its forward PE multiples, its exceptionally low PEG ratio, and its tangible book value suggest it's still priced at a significant discount compared to other tech giants, largely due to investors' historical fears. And third, you're armed with a clear-eyed view of the potential risks. The looming threat of a capex-driven factory oversupply by 2028, acute geopolitical exposure in Taiwan, supply chain fragility, and the brutal zero-sum technological race to HBM4 against integrated giants like Samsung.
It is a delicate balance of staggering opportunity and existential risk. But before we finish up, I want to leave you with one final puzzle to mull over.
Go for it.
It's something that isn't explicitly modeled in any of these financial projections. Right now, the AI industry is essentially brute forcing its way to intelligence. We're throwing massive, power-hungry processors and endless vertical stacks of expensive, high-bandwidth memory at these models just to make them smarter.
It's a total hardware-driven boom.
Exactly. But what happens if the software catches up? What if the next breakthrough isn't a faster silicon chip, but an incredibly efficient new mathematical algorithm?
Oh, wow.
Right? If the next generation of AI suddenly requires half the memory to perform the exact same job, does this entire multi-billion-dollar memory supercycle collapse under its own weight?
That is the multi-billion-dollar question. Continue to watch for our next release.